Hello and welcome back to the Geordie Pick Investor channel, where we delve into the world of dividend investing to help you build a portfolio that pays you. Whether you're just starting out or looking to maximise your passive income, this channel is your go-to resource for strategies, insights and the tools you need to grow yourself steadily over time. Hit that subscribe button and join me as we explore how to make your money work for you, one dividend at a time. First of all, I hope everyone had a great Christmas and New Year. With it being the start of 2026, I thought it was the perfect time to highlight some of the top UK dividend ETFs for 2026. In today's video, I'll be walking you through 3 of the best ETFs available in the UK, breaking down how they track the market and weighing up the strengths and weaknesses of each one. Let's start off by looking at what an ETF is and why I think it should be an important part of someone's long-term portfolio. An ETF, or exchange traded fund, is an investment fund that holds a basket of assets like stocks, bonds or commodities and trades on the stock exchange just like a regular stock. ETFs are great because they offer diversification, liquidity and generally lower fees than mutual funds. They can track an index, a sector or a specific investment strategy, and you can buy and sell them throughout the trading day, which makes them really flexible. I believe you should own an ETF in your portfolio because it provides instant diversification, reduces risk and keeps costs low, all in a single investment. While I genuinely enjoy picking individual stocks myself, ETFs still form the core of my portfolio, and for long-term success, I think it makes sense for you to do the same. For today's video, I looked through a wide range of UK ETFs and I've picked what I believe are the top 3 options for 2026. To choose these ETFs, I focused on several key factors: the expense ratio, current dividend yield, dividend growth rates, and 1, 3 and 5 year performances, and the quality of the underlying holdings. I'll also be sharing a couple of honourable mentions at the end of the video, solid options that just didn't quite make the final cut. Just a reminder, past performance isn't a guarantee of future result, so as always, make sure to do your own research before investing. Anyways, that's enough waffling, let's get straight into it. First up, we have the iShares Core FTSE 100 ETF, stock ticker ISF. This is probably the most well-known UK fund in today's video, and I still believe it is up there as being one of the best choices. The iShares Core FTSE 100 ETF tracks the performance of the FTSE 100 index, which represents the 100 largest publicly listed UK companies by market capitalisation. By holding shares in all of the companies in proportion to the index, the fund gives investors a broad exposure to the UK's biggest firms across a range of different sectors. All of the iShares ETFs are issued and managed by BlackRock, which is the world's largest asset management company. They have over 2 trillion in assets, making them arguably the most reliable issuer on the market. Current price is £9.60. They launched the fund in the year 2000, have a total expense ratio at just 0.07%, the lowest in today's video. They have a dividend yield that currently sits at 3.03%, but they do have a disappointing 5-year dividend growth rate at negative 2.43%, and the reason that they have a negative 5-year dividend growth rate is largely down to broader trends in the UK dividend payouts over recent years rather than anything unique to the ETF itself, since it simply reflects the dividends paid by the companies in the FTSE 100. Across the UK market, headline dividends have fallen or stagnated at times due to the cuts from major companies and a shift in how firms return capital to shareholders, more so by share buybacks instead of higher dividends. So this has dragged down aggregate dividend growth over that period, meaning total dividends paid out haven't been able to rise year after year. They pay their dividend on a quarterly basis and have a fund size at a massive 13,079 million. The top 3 sectors within this one are financials at 22.1%, industrials at 16.4%, and consumer staples at 16%. With the top 3 holdings being AstraZeneca at 8.2%, HSBC Holdings at 7.4%, and Shell at 6.9%, with the 1-year total returns coming in at 25.9%, the 3-year total returns being 44.05%, and the 5-year returns being 72.12%, with their performance over the last 6 months showing positive signs, being up 12.69%. So this ETF is the most established of the 3 I'm going to show you today, having been around for the longest and boasting the largest fund size. You could therefore argue it's the safest option while also still offering a low expense ratio and a relatively solid dividend yield. So I feel this ETF is an excellent choice for UK investors, providing a simple and efficient way to invest in the UK market. Next up, we have the Legal & General Quality Equity Dividend ESG ETF, stock ticker LDUK. This ETF is a UK-focused equity ETF that invests in quality UK companies with a strong track record of dividend payouts, selected based on dividend growth and financial strength, while also applying an ESG screening criteria to exclude companies that don't meet certain environmental, social, and governance standards. It aims to deliver attractive dividend income from a diversified basket of UK stocks, paying dividends quarterly and helping investors combine income with responsible investing all in one fund. Legal & General Investment Management is one of Europe's largest asset managers with over 1.5 trillion in assets under management, so although not quite the same size as BlackRock, it's quite comparable and still a very reliable issuer. Their current price is £12.16. The fund launched in 2021. They have a total expense ratio at 0.25% with a very nice dividend yield that currently sits at 4.94%. And a 3-year dividend growth rate at 3.22%. And the reason this isn't a 5-year dividend growth rate is due to the fact that the fund has only been out for 4.5 years. They pay a dividend, like mentioned earlier, on a quarterly basis, but do have a very small fund size, only 53 million. This definitely could be seen as a potential downside because smaller funds can face liquidity issues, meaning it might be harder to buy or sell large amounts of the ETF without affecting the price. They also carry a slightly higher risk of closure if investors' interest drops, which can be inconvenient. That said, 53 million is not tiny, and since this ETF invests in highly liquid UK large cap stocks and trades on the exchange, buying and selling shares is still generally straightforward, and for most investors, the fund size is likely adequate, especially if it continues to attract inflow over time. The top 3 sectors within this one are financials at a massive 53.4%, consumer discretionary at 14.3%, and industrials rounding it off at 12.3%. And then you've got the top 3 holdings, which are Games Workshop at 6.2%, Lloyds Bank at 5.9%, and Barclays at 5.9% as well. If we have a look at how this one's performed over the last few years, over the last year, it's actually returned a very nice 23.1%. Over the last 3 years, returning 48.15%. And of course, as mentioned earlier, the fund hasn't been out for 5 years yet, so we can't give a 5-year total return. Over the last 6 months, it has performed pretty well, being up 8.68%. Overall, I feel this is a compelling UK ETF to own because it focuses on high quality UK companies with strong and sustainable dividend payouts, using screenings that emphasise dividend growth and excludes firms with poorer ESG characteristics, which can help balance income and responsible investing in one fund. This combination makes it a great choice for investors seeking UK income-focused exposure while still remaining a diversified and straightforward way to invest in dividend-paying UK equities. And for the final ETF I'm going to cover in today's video, it is the iShares UK Dividend ETF, stock ticker IUKD. This ETF is a UK equity ETF that aims to track the performance of the FTSE UK Dividend Plus Index, which is made up of UK companies with strong dividend paying histories. It invests in a diversified portfolio of dividend-focused UK stocks across all sectors, giving investors a straightforward way to gain exposure to quality dividend-paying UK companies while focusing on both growth and income. As already highlighted with the first fund, all iShares funds are issued and managed by BlackRock, which is the world's largest asset management company. As we can see, the current price is £19.15. The fund launched in 2005. They have a total expense ratio at 0.4%, which is the highest expense ratio of the 3 ETFs I've shown you today, but it also offers the most impressive dividend numbers. You could argue that the extra fee is worth it, given it has the most impressive 5-year dividend growth rate, although ultimately it does come down to your own personal preference and what matters most to you. Their dividend yield is at 4.93%, and they have that 5-year dividend growth rate at 11.09%, pay their dividend on a quarterly basis, and have a relatively big fund size at 1,029 million. The top 3 sectors within this one are financials at 36%, consumer defensive at 14%, and utilities at 11%, with the top 3 holdings being Legal & General at 4.7%, Rio Tinto at 4.7%, and HSBC Holdings at 4.3%. If we have a look at the returns over the last few years, we can see on their 1-year returns, they returned 31.27%. On the 3-year total returns, they returned 48.72%. And on the 5-year, they returned 71.21%, with having a very strong previous 6 months being up over 13.4%. So I think that this ETF stands out as a great portfolio holding because it delivers a high dividend yield, offers broad exposure to well-established UK dividend payers, and has a long track record since its launch in 2005, making it a reliable option for investors targeting regular income. It's a mix of top UK blue chip names, and the focus on dividends make it especially attractive for those building an income-orientated core in a UK-centric portfolio. And of course, that 5-year dividend growth rate being over 11% is also very promising. So they make up the top 3 UK dividend ETFs on the market right now, but I did find a few others that were very close to making this list, and I'm going to highlight a couple of them for you now. The first one being the Vanguard FTSE 250, stock ticker VMID. If you're looking for exposure to the FTSE 250 instead of the FTSE 100, this could be a great option. It offers a larger basket of stocks and a higher dividend yield compared to ISF, along with a competitive expense ratio, and has the best 5-year dividend growth rate out of all the different ETFs I've shown you today. That said, its performance over the past 1, 3 and 5 years hasn't been as strong as I'd like, and that's exactly why it didn't quite make it into my top 3 list. So although we are trying to find stocks that pay a good reliable dividend, it's also still important to look at the overall total returns. And the second stock I wanted to highlight for you all was the SPDR S&P UK Dividend Aristocrats ETF, stock ticker UKDV. When I first looked at this ETF, I was really drawn to it because it focuses on high dividend yielding UK companies that have maintained or increased their dividends for at least 7 consecutive years. However, on closer inspection, its recent performance has been disappointing compared to the other funds. Since inception 13 years ago, it has delivered a total return of only 63%, which works out at less than 5% per year, which again, when compared to the other funds, it means it's massively underperformed them. So although on paper this fund sounds like it could perform really well, when actually put to the test, it hasn't quite been able to deliver. It also pays that dividend out on a biannually basis, which can be a little less convenient. So that's a look at some of the best UK dividend ETFs on the market right now. Which one do you think is the best? And do you currently hold any of these ETFs in your own portfolio? Let me know down in the comments. Thanks for watching. If you want to see more videos like this one, then please remember to smash that like button. And until next time, keep compounding and stay patient in the market, because your future self will thank you. For now, this is the Geordie Pig Investor. Over and out.